Option, and in this options trading strategies video we're going to talk about the short straddle. Now the short straddle consists of selling an at the money call and put, and the short straddle profits when a stock price remains right near that short strike as time passes or when implied volatility decreases. So let's go ahead and take a look at the general strategy characteristics for the short straddle and then get into some actual short straddle example trades so you can understand how the position performs in various scenarios. So selling straddles is an option strategy constructed by selling a call and put at the same strike price and in the same expiration cycle. Now typically the at the money strike price is used, and that's because when you sell at the money options, you're selling the most expensive options that consist of all extrinsic value. So if the stock price remains right at that short strike that you sold, you're going to collect all of that extrinsic value as time passes, so long as the stock price does not move significantly outside of that strike price. So the maximum profit potential of the short straddle strategy is the credit received times 100, and that is only realized if the stock price is right at the straddle strike at expiration. So that's a very low probability event of realizing the maximum profit potential, but since you're collecting such a large credit for selling a straddle, you can still make a very, very healthy profit if the stock price is anywhere near that short strike at expiration. Now, since the short straddle strategy includes a short call option that is not covered by long stock or another offsetting long call option, there is theoretically unlimited loss potential on the upside for a short straddle. Now, that's because there's no limit to how much a stock price can increase, so therefore you have unlimited loss potential on that short call, in theory. Now, the break-even prices of the short straddle are going to be the short strike that you sell, plus the credit received, and also minus the credit received. So that credit that you collect creates a nice wide range around that strike price that you sell. So the estimated probability of profit for a short straddle is typically between 50 and 60%. Now, the resulting position after expiration depends on if your short call or short put is in the money at expiration. If your short call is in the money at expiration, you'll be assigned negative 100 shares of stock per short call option, which is essentially a short stock position of 100 shares per short call. Now, if your short put is in the money at expiration, you'll be assigned plus 100 shares of stock per short put contract, which basically means you'll be buying 100 shares of stock per short put contract. Now, in regards to assignment risk, if the short call is in the money before expiration, the assignment risk is negative 100 shares of stock per contract, and if the short put is in the money before expiration, the assignment risk is plus 100 shares of stock per contract. So now that you know the general strategy characteristics for the short straddle, let's go ahead and construct a hypothetical short straddle position and check out the expiration risk profile graph. Alright, so in this example we're going to construct a short straddle position from the following option chain. So at the time of these option prices, let's say the stock price is trading at $250, and we want to put on a directionally neutral trade that's going to profit if the stock price remains right around $250. So to do this, we're going to sell a straddle, and we're going to sell the 250 straddle. So we're going to sell the 250 call for $15.20, and we're going to sell the 250 put for $15.10. So the net credit in this case is $30.30. So based on this position, let's go ahead and take a look at the expiration risk profile graph. Alright, so as we can see, the maximum profit potential of $3,030 occurs if the stock price is right at $250 at expiration. Now that's because we collected a net credit of $30.30, and in dollar terms that means we collected $3,030 in premium, and if those options both expire worthless, we will keep the $3,030 premium we collected. Now, of course, that only happens if the stock price is right at $250, which, as we can see, is a very low probability event. So our break-evens for this trade are going to be the strike price that we sold, which is $250, minus the credit of $30.30, and also plus the credit of $30.30. So our break-even range in this trade is $219.70 all the way up to $280.30. So while the maximum profit potential is achieved if the stock price is right at $250, we can make money on this position if the stock price is anywhere between $219.70 and $280.30. So as we can see here, we have a pretty wide profit range, But if the stock price makes a considerable move to the upside or downside, we do have significant loss potential. So if the stock price in this case falls to $150, we'll be down about $7,000 per short straddle. And on the other hand, if the stock price increases to $350, we will also be down around $7,000. So while the short straddle has significant profit potential and a pretty wide range of profitability, there's significant loss potential when the stock price makes an outsized move, so you definitely need an exit strategy when using this position. So let's go ahead and briefly discuss the short straddle Greek exposures so that you can understand how the position performs before expiration. So typically you'll be selling an at-the-money straddle, which means that your directional or delta exposure will be right around zero. So you're going to have very, very little directional exposure to small changes in the stock price. Now in regards to gamma, a short straddle position has negative gamma. Now that means when the stock price rises, a short straddle becomes more short because its position delta gets more negative. And when the stock price falls, a short straddle position becomes more long because its position delta will be more and more positive. Now in regards to theta, a short straddle position has positive theta. Now positive theta means that you make money as time passes because the options that you're short are losing extrinsic value. So if the stock price is very calm and implied volatility is not changing, as time passes the extrinsic value of options decays over time, and that leads to cheaper and cheaper option prices and therefore profits for a straddle seller. So a short straddle position has positive theta. Now lastly, a short straddle position has negative vega, which means that increases in implied volatility are harmful and decreases in implied volatility yield profits. Now that's because an increase in implied volatility indicates that option prices are increasing. And when you sell options or you sell a straddle, you want option prices to decrease. So naturally, an increase in implied volatility is a bad thing. On the other hand, a decrease in implied volatility indicates that option prices are falling, and since you're short a straddle, that is good for you because when you sell a straddle, you want the straddle's options to decrease in price. So if you have a implied volatility decrease, a short straddle can make money from that. So when you bring all of these Greeks together, you learn that a short straddle position makes money from the passage of time because it has positive theta, and it makes money from decreases in implied volatility because it has negative vega. Now on the other hand, a short straddle position can lose money from an increase in implied volatility or a significant stock price movement in either direction. So as long as the stock price does not move significantly in either direction and implied volatility does not increase, a short straddle position will profit from the passage of time. Alright, so let's look at our first example trade. So here is the setup. So the initial stock price is $210.72. Initial implied volatility is 15%, and we're going to sell the 211 put and 211 call that expire in 77 days. Now for selling these options, we're going to collect a net credit of $9.78, and that's going to bring our break-even prices to $201.22 on the downside and $220.78 on the upside. So our maximum profit potential in this case is the credit of $978 times 100, which comes out to $978. Now, as always, our maximum loss potential is theoretically unlimited. Alright, so in the top part of this graph, we're looking at the changes in the stock price relative to the short straddle's strike price and also the break-even prices of the strategy. And in the bottom part of the graph, we're looking at the entry price of the short straddle and the changing price of the short straddle through time, as well as any corresponding profits or losses based on that new price. So as we can see here, the stock price remains right around the short straddle strike of 211 over the entire trade period, and as we can see, the straddle's price decays over time. So that's really that positive theta that you see working there. So we sold the straddle for $9.78, and through time, and as time passed and the stock price was right around the strike price, the straddle's value decreased because the extrinsic value of that call and put option was decreasing over time. Now at expiration, the straddle's price was worth just less than $2.50, so we essentially made around 75% of the maximum profit potential on this trade. Now since the 211 call is in the money at expiration and we're short that call, If this position is held through expiration, then the trader would be assigned negative 100 shares of stock per short call contract. So if you did not want a stock position after expiration, you'll always have to buy back the short straddle before the option expires. Otherwise, you will have a stock position. So in this case, you could just buy back the short call since that is the option that is in the money, but it's always advisable to just go ahead and buy back both options when you're short them. So before expiration, if you do not want a stock position, you'll have to buy back the straddle at its current price. Alright, so example number 2, we're going to look at a short straddle's performance when the stock price collapses. So obviously that's not going to be a good thing. So here's the setup. The initial stock price is $126.20. The initial implied volatility is 23%, and we're going to sell the 126 straddle expiring in 78 days, and for that we're going to collect a $10.25 credit. Now our break-even prices for this trade are going to be 115.75 on the downside and 136.25 on the upside. So the maximum profit potential is, of course, the credit of $10.25 times 100, which comes out to $1,025. And as always, the maximum loss potential is theoretically unlimited. Alright, so in the top part of this graph, we're looking at the changes in the stock price relative to the short straddle strike price and the break-evens of the trade. Now in the bottom part of the graph, we're looking at the price of the straddle as that stock price is changing. So as we can see here, the stock price remained right around that strike price of 126 for, the first 25 to 28 days or so. Now, unfortunately, the stock price started to sell off, and as we can see here, the stock price dropped off to a price of about $85 at the lowest point. Now, as we can see here, while that stock price was decreasing, the straddle's price exploded. So we sold the straddle for $10.25, and at the highest point, the straddle's price was just over $35. So that represents a loss of around $2,500 per short straddle. So at expiration, that short put was deep in the money, and the stock price was well below the lower break-even of 115.75, and therefore this position realized a loss. So the straddle's price around expiration was right around $32.50, so the final loss at expiration was right around $2,250 per short straddle. So this example just demonstrates that when you sell a straddle and the stock price makes a significant move in either direction, you will have significant loss potential from that movement. So when you sell a straddle, you really need the stock price to remain between your break-even points. Now earlier we talked about how a short straddle has negative gamma, which means that as the stock price increases, the position becomes more short, and when the stock price decreases, the position becomes more long. So in this graph, we're looking at the same stock price movement as the previous example, except on the bottom part of the graph, we're looking at the position delta of the short straddle. So as we can see here, when we first sold the straddle, the position delta was right around 0, which means we didn't really have any directional exposure to changes in the stock price. However, as we can see, when the stock price started to sell off and was well below the lower break-even price of 115.75, we can see that the position delta was growing more and more positive, and that's because the short puts position delta was growing more towards plus 100, while the short calls position delta is approaching 0. So as the short put becomes deeper and deeper in the money, the short straddle position starts to act more like a long stock position. So we can see that by the position delta changing from around 0 all the way up until plus 100. Now at expiration, it makes sense that the short straddle's position delta was plus 100 because the short put was in the money. And a short put that is in the money at expiration will expire to 100 shares of long stock. So this just shows that if you have a short straddle, initially it will be directionally neutral, but if the stock price collapses significantly, your short straddle position is going to act more and more like a long stock position. Now on the other hand, if the stock price rallies significantly higher than your upper break-even and that short call is in the money, your short straddle position is going to perform more and more like a short stock position. So just keep in mind that even though you're starting with a directionally neutral position, you could very well end up with a position that is closer to a long or short stock position. All right, in this final example, we're going to look at a break-even short straddle, and that occurs when the stock price expires right around the short straddle's break-even price at expiration. So here's the setup. The initial stock price is 210.56, and we're going to sell the 211 put and 211 call expiring in 60 days. Now for this straddle, we're going to collect a credit of $8.34, and that's going to bring our break-even prices to 202.66 and 219.34. So the maximum profit in this case is the credit of $8.34 times 100, which comes out to $834. Now, as always, our maximum loss potential is unlimited. So let's go ahead and see how this short straddle position performs through time as the stock price is changing. Alright, so as we can see here, the stock price starts right around 211 and immediately falls down to around 185. And over the course of the entire trade period, the stock price is well below the lower break-even price of 202.66. Now, as we can see here, the straddle's price increased from our initial sale point of $8.34, which means we did have a losing trade for almost the entire period. However, the stock price did rally back and was right around our lower break-even price of 202.66 at expiration, in which case the straddle broke even. So as we can see at the end of that bottom graph there, the profit and loss of the short straddle was actually slightly positive, but essentially a break-even trade. Now, since the short 211 put is in the money at expiration in this example, keep in mind that if you held this position through expiration, you would be assigned plus 100 shares of stock per short put contract. So anytime you have a short option at expiration, if you don't want to be assigned a stock position, you'll have to close that option. So in this case, at expiration, if you did not want a stock position, you'd have to go ahead and buy back that short put at a loss. Alright, let's go ahead and summarize the main concepts that you've learned from this video. So first and foremost, selling straddles is a directionally neutral strategy that consists of a short call and short put at the same strike price and in the same expiration cycle. Now, the most common setup for a short straddle is to use the at-the-money strike price. Now, that's because the at-the-money options are the most expensive options that consist of all extrinsic value and therefore give you the most profit potential for a short straddle. Now, the main drivers of profits for a short straddle position are the passage of time, since a short straddle position has positive theta, and decreases in implied volatility, since a short straddle has negative vega. So to close a short straddle position before expiration, you can buy back the short call and short put at their current prices to lock in any profits or losses you have in the trade. So if you sell a straddle for $10 and it drops down to $5 and you want to take that 50% profit, you can go ahead and buy back that short straddle. Now, on the other hand, if you sell a straddle for $10 and it goes to $20 and you want to stop the bleeding, you can, of course, go ahead and buy back that short straddle for $20, in which case you'll lock in that loss of $10. Now, due to having unlimited loss potential and limited profit potential, short straddles are high probability trades. And though a short straddle position begins directionally neutral, the position will become directional if the stock price trends in one direction. So we just went over an example of that, and now you know that if the stock price moves significantly up or down, your short straddle position will actually start to behave more like a short or long stock position.